In today's Government Shutdown 2023 update, we highlight a looming crisis. How will a government shutdown affect you? And will the government shutdown affect the stock market? Join us as we break down the answers to these questions and reveal why the government might be shutting down. First things first, what is a government shutdown? It all revolves around something you've probably heard about this year, the debt ceiling. Put simply, the debt ceiling is like the maximum amount of money that the United States can borrow to cover its bills. These bills include things like Social Security, Medicare, military salaries, interest in the national debt, tax refunds, and a whole bunch of other services that our country needs to keep running. When you see that colossal $33 trillion national debt, it's not there by accident. Lawmakers set a budget that limits what the United States can spend. Even though the country came close to defaulting on its debt earlier this year, it's once again facing a critical issue, the 2024 budget. So what's the problem with the 2024 budget? Well, this budget sets the maximum amount of money our government can spend. It's like a financial safety net. When we get close to that spending limit, it's like approaching a red flag, a sign that we might not be able to pay all our bills on time. Now here's the tricky part. If we hit this budget limit and can't borrow more money to cover our bills, it could lead to a government shutdown. That means some important government functions may come to a standstill, and that's not good for anyone. So how does this impact you? Well, the consequences of a government shutdown can be felt far and wide. Let's break it down. First, there could be delays in payments. This includes things like Social Security checks, Medicare benefits, and military salaries. If you rely on these payments to cover your living expenses, a delay can create financial stress. Second, if you're waiting for a tax refund, that could be delayed as well. Tax season is already stressful enough without added delays. Third, a government shutdown can have a ripple effect on the economy. It could slow down economic growth and hurt job opportunities. Fourth, government services like national parks, passport processing, and more could be affected. You might find it hard to access certain services. Fifth, a government shutdown creates uncertainty. You might not know when things will return to normal, and that's never a comfortable feeling. Lastly, the stock market can become more volatile during a government shutdown. If you've got investments, this could impact your portfolio. So what can you do to prepare for the possibility of a government shutdown? While we hope it won't happen, it's always good to be ready for the worst-case scenario. First, review your budget. Make sure you have some savings set aside to cover your essential expenses for a little while. This can help ease financial stress during a shutdown. Second, stay informed. Keep an eye on the news and government updates. The more you know, the better you can plan. Third, consider building an emergency fund if you don't already have one. Having some savings for unexpected situations is always a smart move. Fourth, contact your creditors and service providers. If you anticipate a delay in payments, discuss your situation with them and see if there are any options available. And finally, explore local resources. In some cases, local organizations may offer assistance during rough times. It's worth looking into. Let's dig deeper into why all this is happening and what it might mean for various aspects of our lives. To understand the cause of a government shutdown, we need to look at the complex world of budgeting in the United States. Even though Congress had previously agreed to raise the total debt ceiling until 2025, how they allocate that money is a whole different story. Normally, budgets are approved at the end of the fiscal year on September 30th. This budget sets the plan for the next year's spending. If Congress can't agree on this budget, we end up with what's known as a government shutdown. Now, you might find it hard to believe that an entire government could shut down just because members of Congress can't agree, but it's true. The Anti-Deficiency Act of 1884 prohibits federal agencies from spending money without congressional approval. In the absence of bipartisan agreement, non-essential government activities grind to a halt, including vital functions like data collection, processing, and analysis. Such data informs crucial decisions such as employment and inflation figures that the Federal Reserve relies on for interest rate determinations. Now let's talk about why this political standoff is happening in the first place. It's not necessarily for the reasons you might expect. In a smoothly functioning political landscape, budgets pass through the House of Representatives, get approved by the Senate, and are signed into law by the President. However, 2023 presents a challenge. The House of Representatives is controlled by Republicans, while the Senate has a Democratic majority. For any bill to pass, everyone has to come to an agreement. That means somewhere along the way, someone has to compromise. But things get even more complicated. The House of Representatives, despite being led by Republicans, is divided. Some members insist on including spending cuts in the upcoming budget. This is where politics enters the equation, as the House Majority Leader Kevin McCarthy had made promises to different factions within his party, ranging from ultra-conservatives to moderates, to maintain his position. Trying to satisfy all these demands without alienating someone is incredibly challenging. So the choice for McCarthy was clear: push for spending cuts that are unlikely to pass in the Senate, leading to a government shutdown, or compromise to keep the money flowing and risk his job. This deadlock means that publicly, Republicans must first compromise among themselves before attempting to find common ground with the Senate. A government shutdown has immediate and lasting impacts on various aspects of life. In the short term, the White House warns that active duty military and federal law enforcement personnel may work without pay, and FEMA's disaster relief funds could be depleted. Virtually all federally funded agencies, from TSA to the FDA, would be affected, potentially reducing the gross domestic product by 0.2% per week. Moreover, a shutdown could disrupt official statistics like the September Jobs Report and Consumer Price Index, crucial for Federal Reserve decisions. When it comes to the stock market, the impact is mixed. While the worst government shutdown in the 1970s saw stocks drop nearly 4%, in late 2018, when the government was shut down for over a month, the markets rallied over 13%. Some of the most directly affected sectors include defense firms, healthcare companies, and other government contractors. However, for the broader market, the direction of corporate earnings, interest rates, and other macroeconomic factors carries more weight. Beyond the numbers and market fluctuations, the true issue lies in the loss of confidence in the economy. Shutdowns signify a lack of unity within the United States and create hardships for government employees forced to work without pay or go through furloughs. Eventually, things return to normal, but not without their challenges. There's more to consider. We often hear about how the United States manages its finances, but one aspect that doesn't get enough attention is the United States credit rating. Similar to individuals' credit scores, every country has a credit rating, reflecting its ability to repay loans. For years, the U.S. has maintained a pristine AAA rating, signifying its status as a global reserve currency and a history of punctual debt repayment. However, in a rare move, Fitch downgraded the U.S. to AA+ on August 1st, spurring a stock market decline. This change affects the interest rates the U.S. must pay when borrowing money. A lower rating implies higher interest rates and, consequently, more money leaving the country. The downgrade reflects concerns about the U.S.'s fiscal outlook, mounting national debt, and governance compared to similar rated countries. The country came dangerously close to a government default earlier, given its $33 trillion debt and rising interest costs. While a default seems unlikely, the issue is eroding investor confidence. Moody's, the sole major credit agency yet to downgrade the U.S., warns that ongoing political divisions could worsen its credit situation, posing a potential threat. In reality, it's likely that just before a shutdown would occur, a last-minute agreement will be reached. Emergency bills might be used to fund the government for a few weeks, providing more time for debates and discussions. While this isn't the ideal way to handle finances, it's a better outcome than a full-blown shutdown, which benefits no one. Eroding investor confidence is the real cost of such political games. If you think the U.S.'s economy and political situation is bad, you'll be shocked to learn the deep waters Canada has gotten itself into. Click the video on screen now to learn more about the problem with the Canadian economy.